Hey Steve, what's going on? Tyler, I don't think I've met you before. Are you on the home buyers team or are you an
Yeah,
independent
buyer's
agent?
agent. He's a buyer's agent. He's
I
actually
am, yes, I'm new to the
yeah.
team.
New to the team.
Nice to
Okay,
meet
how
you.
long you been in real estate for? New to real estate too, or just the team?
New to real estate as well.
Right on. Okay.
Just getting started.
Nice, nice. Well, hopefully some of the info I share can be helpful with you guys.
Absolutely.
So I was kind of thinking like what would be a good topic to share today? I know last week we went over some just some basic loan information. We went over, maybe structuring offers a certain way and how we can kind of be competitive in the market. We can talk a little bit. I know we have about 30 minutes, but a little bit about just market conditions. I feel like, let me see if I can share my screen here. So
Is it allowing? Okay, yeah.
yeah, there we go. A lot of the folks that are smarter than me have, economists and whatnot are predicting a bit of a recession that could be on the horizon for us here. What's happening, and I'm sure you guys have seen on the news, there's been huge worries with the Fed as far as inflation is concerned, right? Our inflation is kind of outpacing even like our job wage increases and things of that nature, cost of living increases. So when that starts to happen, it puts a really huge burden on the economy. So what the Fed is doing is they're raising the federal fund rate, making changes to policies to try and hold off inflation. And what that's doing is you can obviously see is we're having that increase in interest rates. And I'm sure you guys have noticed a little bit, especially after the last 2 years. Tyler, I know you're pretty new to it, but the last 2 years have been kind of the Super Bowl for real estate and lending. It was just bananas, right? Record low interest rates, super competitive market. Everyone had money to buy. The stock market was doing well. Folks were, seeing their 401k really blossom and stock accounts blossom, and they were pulling money out, buying homes left and right. And we just didn't have enough inventory, which I believe we're still in sort of that predicament where there just isn't a ton of houses. But what's happening now with this increase in interest rates is that, and what will potentially happen when we hit peak inflation, which is predicted to be around September or October of this year, somewhere towards the fall or winter of this year, that's when you can potentially see a recession come into play. And with that, it should, number one, when a recession does hit, like it did in basically 2008 to 2010, I was doing mortgages during that time. It was, a foreclosure crisis, right? Everything was going pretty wild back then. Interest rates got lower, and a recession has usually there's been a positive. It's a positive for the housing market. Supply chain loosens up a little bit, and I think that is what's going to happen in our industry as well over the next 6 to 9 months. We could potentially see that. So I guess I say that to just say, outlast this kind of temporary, tough market that we're in now, where we still have very low inventory, interest rates are up, and buyers might be getting frustrated. So every time that the Fed has tried to curb inflation, it's had a recession that's followed. So here's some of the information I was looking at today, where you can see over the last 70 years, when the Federal Reserve would spike up the federal fund rate, you would see a little bit of a correction. And more recently, I guess we can pull up, here's, let me move my screen here. Look at this graph right here, where we're looking at 2009, right? The federal fund rate was extremely low, and you saw inflation start to rise. And then we came back here. This is May of 2020, which was basically COVID, right? The pandemic, they reduced that federal fund rate, and then we're going to see inflation start to rise again, like we're seeing now. So I guess I say that just to say, what can we do to set ourselves up for when there is more inventory, there is a reduced or a better supply chain? What are some of the tactics that we can install where we can really set ourselves up in position to kind of take advantage of that market share, right? A few of the things that we're doing on our team is just really touching base and keeping contact with our past client database. Those are the folks that have experienced working with you, that must like you and they must trust you, right? If they decided to use you, or you help them do something really significant in their life, which is purchasing a home. It's one of, if not the biggest purchase that the average person makes in their entire lifetime. So being able to draw back on them, check in with them, see how they're doing, even if it's a conversation that sometimes you may not want to have, because let's say it was a client that for one reason or another, you just didn't follow up as well as you maybe should have after their deal closed, right? Maybe you got busy, maybe they went out of town, or whatever the case may be, and you haven't talked to them in months. That's sometimes a little bit of an awkward conversation to have. If they may get a sense of like, oh, wow, they were really friendly during the transaction, and after it closed, I never heard from my realtor or my lender again. So a lot of times, if there was a scenario like that where we just didn't do the best job following up and checking back on them, I'll start off that conversation with just a flat out apology. Just say, hey, Mr. Smith, I'm so sorry that, I didn't follow up as much as I normally do. No excuses, but I wanted to check in with you. And a lot of times that conversation, if you start off with that apology, most of the time they're just like, oh, no big deal. Thanks for checking in, Josh. Hey, how's the house doing? Oh, it's great. We're loving it. We actually started to work on some remodels and we redid our kitchen, or whatever the case may be. And it's really good to keep that relationship going. And then, don't be scared to ask for business, right? At the end of that conversation, after you've checked in with them, ask them, hey, who else do you know that could use our services? Right? A lot of times that's how you word that question is huge. Not asking, hey, do you know anyone that's interested? Because then that could be an easy, like, oh no, I don't know anyone. But if you ask them who, then they have to kind of think. It's not a yes or no, yes or no type of question. So if you guys have any sort of marketing materials, things that you can, mail out in this digital age, I feel that people receiving things in the mail, it takes a little bit more of an effort for you to send something off, right? A little thank you card, a check-in, maybe an update on what you're doing with your life, whatever the case may be, a handwritten note. A lot of times that goes a lot further than just blasting off multiple emails to multiple people. So in this market, in these next couple months where things might get a little tight, maybe you're already feeling that they are a little tight, go back to the last 3 years, 4 years of people that you've helped, close loans with, if you've been doing, real estate for that long. And it doesn't hurt to make a phone call or send a letter or do something that can kind of keep that relationship going. Do you guys have anything that you are coming up against, any sort of scenarios or maybe objections that you're getting from buyers that you're dealing with, or anything common like that that's you need help with overcoming, maybe an objection?
Just people
No, go ahead.
saying
Sorry, I
like,
kind of
oh,
threw that out there. Go ahead, Emily.
what?
I said, go ahead.
Okay, I said just people saying like they don't want to buy right now because they're just waiting for the market to crash, and so that's just discouraging, I guess.
Right. What are some of the things that you say when they mention that kind of objection?
Well, Eva made a good point, and you know, these people are usually renters, and so she told us to tell them they're paying 100% in um they're paying 100% interest in rent, so they're just throwing their money away when you know they think they're making a smart deal by you know waiting for the interest rates to go back down or waiting for the market to crash when that's not always the case.
Correct. Yeah, and that's actually one of the things we went over last week where we showed how much an initial investment, and one of the things you ask folks, right, when they're looking to buy is, hey, what's your time frame? What's the reason you're wanting to buy? And how long do you plan on being in that home, right? For someone that's like, well, I just need a house for the next year, which most people don't say that, but a year or two, and then we're going to move to, you know, Idaho or something. Well, then that might be a little bit of a different conversation from an investment standpoint. But if someone is looking to purchase a home, and let's say they maybe have young kids that are in elementary school and they're like, hey, yeah, we want to buy and we want to, you know, stay here at this house or in this area until, you know, our kids are out of school or whatever the case may be, then you can really look at the long-term projection of a real estate investment and show them, hey, look, if you put your minimum down payment, whether it's 3%, 3.5%, 5% plus closing costs, you put up that money, here's what the 5-year appreciation or 10-year appreciation of a property can do for you on average in Tracy or Stockton or Manteca or whatever, you know, city they're looking to buy, and literally show them, hey, if you take that $30,000, that can turn into 150 in the next 5 years. On top of the fact that you're paying towards your own mortgage, right? Towards your own investment, as opposed to, like you said, paying 100% interest on someone else's investment, putting money in someone else's pocket. So a lot of times, if you can just show them that no matter what happens with the market, unless you're someone that's flipping homes and looking to make quick money, that it's more of a long-term deal when you get into a home. And there's always opportunities to refinance. So that's one thing I'm 100% saying to folks right now is, hey, look, we'll get you into the home now. Don't worry about the interest rate as long as the payment's affordable for you. If there's any opportunities in the next year, 2 years, 3 years to knock that rate back down, we'll do that for you. But the home value is going to continue to appreciate, especially in this. I think the Central Valley is really unique, right? With the fact that we have so many Bay Area buyers that make decent money with the Bay Area wages, but want to come this way and purchase more affordable homes, more affordable housing, more bang for their buck. And especially with a lot of these companies that are kind of changing their business model to work remotely. I mean, even home buyers, right? I mean, I know you guys have access to an office if you need it, I believe, but you guys are pretty much quote unquote remote workers, right? So I don't see any slowdown in appreciation in the Central Valley or a crash coming. So that's one thing that you could probably say to them, Emily, is like, look, we don't see a crash. If people say that, then they don't understand what caused the last housing crash, or maybe they were too young, or maybe they just haven't done enough research. But that last housing crash was 99% because of bad mortgages, bad loans, just people overextending themselves. And they've made a complete, and I've been through that correction. I mean, there's so many guideline changes that have happened over the last 10 years. It's crazy, or 15 years, from what literally loans were. I mean, it was insane, the subprime market. People could do a stated income loan where they would just say, hey, I own a landscaping company. I've been doing this for X amount of years, and I make $10,000 a month. And then that's what the lenders would use to qualify them based on, and put 0% down. 80-20 loans where you're doing a first and second. I mean, it was nuts. Yolanda, do you remember those kind of loans back then?
Oh yeah, that was crazy. But that's actually been my conversation with, buyers coming through open houses or whatever, because, right away they're like, well, what do you think? Do you think the market's going to crash? That's exactly what I've been telling them. I'm like, no, I don't see a crash. Like immediately I tell them no. Will things start to settle down a bit? Yes, they will. They have to, right?
Yeah, they
But
needed to, right?
they have to, exactly. I mean, that's actually, normal. Things could not continue at the rate they were. But exactly what you said is like, okay, rates are up right now, but at one point they possibly will come down, and that's when you can refi,
Yeah.
get into the home now. So, I mean, once we have that little conversation, then they're like, oh, that makes sense. Like, yeah, you're right. And
Right.
then that whole conversation shifts.
And just so you guys know, I mean, just to give you a little bit of loan info here. So let's just say, let me share my screen again. Like, let's say someone is, I know Tracy's a little different, but let's just take maybe like a $600,000 purchase price, someone putting 5% down, they're taking out a loan for 570,000. And let's see, Freddie Mac has today's average rate on a 30-year fix is 5.1. So we'll just say average, because obviously someone with 760 credit is going to get a little bit better. Someone with a 640 credit score or 660 credit score might be a little bit higher. So they take that average. So let's just use that for now. The principal and interest payment on a $570,000 mortgage is $3,095 per month. Now, if they were, let's say rates were to go back down, I mean, I doubt that we'll ever see, I mean, I don't want to say ever, but we came from an environment where 2.25%, 2.5%, 2.7%. I mean, that was just
Not normal.
absolutely insane, abnormal. It was an anomaly. I mean, I would say that a 3.99 or 4.25 rate is awesome. Like if you can have that locked in for a 30-year fixed loan, that's, you're doing really well. So let's just say that this client, for example, bought a house and ended up with a 5.1% 30-year fixed, a payment of $3,095. And then next year, maybe midsummer, recession hits, Fed does, come back into play a little bit, starts buying mortgage bonds again to get rates a little bit low. Maybe they get down to a 4.25. So that's 2804. So what's the difference there? It was a 3,095 minus 2804. So $291 per month, which is a good amount of savings. That's why the last 2 years, in the lending industry, we were helping so many clients because they were saving a ton of money. But even that $290 per month isn't a huge stretch for someone. It's not like, oh my God, my payment went down $1,000 a month, or what they're paying now is just, an extreme overreach from a budgetary standpoint, right? I mean, if you're buying a home for $600,000, you most likely make pretty decent money. And that $290 per month difference of what maybe you could have gotten a couple months ago to now may not make or break your budget. You may be able to figure out how to pay that slightly higher payment now while getting into a home as prices go up. So I do think that is not that big of a stretch for folks. You know what I mean?
Basically, it's a little bit more than a extra payment a year.
Extra payment a year, yeah, a little bit. So, and again, can we see rates continue to increase over the summer? Yeah, definitely. So that's something that, we can use as a little bit of our selling tool, and just start throwing these things out there, inflation worries, the Fed fund rate. I would say most homeowners probably don't really research that anyway.
Quick question. So from a lending point, you're saying a normal healthy interest rate is around 4%? Is that what you said?
I mean, I think that would be like awesome.
That's an ideal, like an ideal healthy. So I mean, even at 5%, we're not that far off.
No, it's not. I mean, this is really where rates were at pre like 2017, 2018. It was like 4.875, 4.75,
Yeah.
5.25 if you didn't have like the ideal credit and things like that.
Right.
There's usually,
yeah, because I remember when I purchased my first home back in 96, I think it was like 8%, I want to say.
Yeah, exactly. And a lot of times folks will get, they'll just hear it on social media or the news. I mean, I know there's a ton of like lenders, I see it all the time on social media. They're all posting stuff, making jokes about rates and things like, oh, you should have locked in yesterday's price and all kinds of stuff. So it's just kind of like social media is crazy now, right? The media is crazy. You can just get all your info, and whether it's accurate or not, it's just in your face all the time. So a lot of times folks just think that like, oh, rates are up and it's not a good time to buy. But when you really show them like factual information, here's a chart of what the average 30-year fixed mortgage rate has been over the last couple of years. So here is, let's see, this is 2017, 2018 was 4.5, 4.5. We got all the way up to 4.9, 2018, 4.94 in November of 2018. So historically, not bad at all. We're still actually doing really well. Now, this is what you were talking about, Yolanda, back in, 2009, 2000. This is when I got into the industry, about 2006. 6.74% was the average, 30.
Oh no, I was saying 96.
Oh, 96. Oh yeah.
96.
Yeah, I mean, we go back there. Yeah, 8%.
Yeah,
May of
see,
96 was 8%.
I wasn't too far off.
Yeah. So historically, still really solid. So that shouldn't be something that keeps people from wanting to buy. And then really what I do on the lending side, that's one of the first conversations I'll have with them, because I don't focus on rate. I like, hey, what is your max payment that you feel comfortable with, regardless of anything, what I can qualify you for or not? What's your max monthly payment that you feel you could budget with in this market with your current lifestyle? And a lot of times it starts off really low. They'll say like, $2,000 or whatever the case may be. And then we'll start kind of molding a loan around their specific needs and wants and what they qualify for. Some folks may qualify for a $3,500 mortgage payment, but they don't want that. And then that's where we can jump in as a lending realtor team. Yolanda and I recently did a joint Zoom call with a buyer. And once we have her dialed in, we're going to do another one where we actually present what she qualifies for and all the different, options for her. But those are some of the questions that we asked, was like, hey, what is your monthly payment? What do you feel comfortable with? And once we start going over that, then we can kind of give them the reality of the expectations and say, well, if you want a $1,500 mortgage payment, that's not going to get you much of a house right now, right? You'd have to go with like I don't know, whatever that is, a $250,000 home, which in this market isn't going to get you much of a house at all. It might be like a condo or a mobile home or something, right? So, and I think that's also where we build a huge amount of trust with the client, is, hey, we're listening to your needs. We're listening to what worries you, that you don't want to overextend yourself on a monthly payment. And I don't think, from a lending perspective, I don't think a lot of the big name lenders are taking the time to do that, like the Quicken Loans of the world, the Bank of America, Chase, Wells Fargo. That's where kind of our independent mortgage banking, these, lenders like myself that have been doing it for a long time and really are more relationship driven than transaction driven. That's how we can kind of separate ourselves from the pack and give ourselves a little unique voice in this market. So yeah, I really encourage you guys, especially if you're working with me. I do not think it's a bad idea that once I go over what I call my mortgage planning session, after we get their application, we go over their credit, we go over their income, then we set up a mortgage planning session that's usually Zoom in this day and age. And we take about 45 minutes and I go over what they qualify for, answer their questions, do different adjustments. I encourage you guys from the real estate side to hop on that call, especially if it's like a internet lead that you maybe don't have a ton of relationship built with them yet, or a ton of rapport. I think that can show that you're really committed to, the process with them, and, are there to maybe answer any sort of real estate questions when I'm going over their qualifications. And then it's also a really good time to talk about the structure of the offer while we're, if it's a really strong approval, we can talk about right off the bat, removing loan contingencies, shortening escrow periods, removing appraisal contingencies if they have a decent amount of cash. Or if they're like someone that's using a down payment assistance program, or maybe they're getting gifted funds from a family member, and they don't have a lot of extra cash, then maybe we don't bring that up when we talk about how we can structure their offer a different way. I think those are the type of things that can definitely separate us from the pack, though. So if you guys do have time, hop on one of those calls. We'll send you a link. We'll put it on your calendar. And I think that can be a good thing for all of us.
Wow, that's very insightful, Josh, today's session. Yeah, thanks a lot for your time.
Yeah, thanks, guys. I wasn't sure exactly what to talk about. I know the last one we went over a few different things. I don't want to go into too many details on the different loan programs, because honestly, at the end of the day, that's my job, is to kind of take those things off your plate. I want to arm you guys with at least enough knowledge to be able to talk, accurately about loans. But at a certain point, I want you to be able to say, hey, look, if you have some in-depth loan questions, then talk to the lender, and you guys can focus on, your clients and the actual real estate side, and not have to have the burden of answering a bunch of loan questions,
Yeah, we appreciate your time, Josh. Thanks so much for being with us here.
Yeah, you got it. All right, guys, have a good weekend.
Have a
Thanks,
great day,
Josh.
everyone. Bye.
All right.